Let's start with a comment from Fook Hien Yap, Senior Investment Strategist at Standard Chartered Bank, joining us this morning. Welcome and thank you so much for speaking with us here at NDTV Profit. Great to have you on. Just your reading on this anxiety which seems to have come in on the pace of rate cuts. You think it's overblown looking at 1 month's CPI data, Fook?
Yeah, thanks very much for having me and thanks for the question. Yeah, I think it did come out larger than expected, the inflation, but we think the disinflationary trend is still there. The component, which is the largest component of inflation, is the shelter or housing, and that is actually showing a deceleration from 0.5 to 0.2%. So we think that is in line. It's going to be driving disinflation, which we expect will then allow the Fed to do rate cuts. Look, I think the upside surprise came from some of the more volatile items like your vehicle cost, the insurance along with that, and the airfare as well. We've seen the oil price come off, so airfare should also come off. So some of the bit more volatile components were a bit hotter than expected. But with something like shelter coming down, we think the disinflationary trend is going to be intact. So we still expect the Fed to be on the path of the rate cuts. And we still expect 2 more rate cuts this year in line with the dot plot. And then some more we'll see next year as well.
Okay. The question only is whether this sets the cats among the pigeon when it comes to people who are penciling in a series and a linear trend of rate cuts. Would you believe that is under a serious question mark now? And it may change, of course, in the future, but is it under a serious question now?
Yeah, I think we've seen one print, which is, I think people would normally try to see a few more in order to make a trend. And I say, if you look at the components, the large components, something like shelter, is something that is still in addition inflationary trend. So that is reassuring. But look, I mean, I see what you mean. The market is pricing in a lot of cuts. Because I think it has been volatile. It was pricing in much more by the end of 2025. Our own view is that we get two more cuts this year and another 4 cuts by September. So that's going to be easily 1.5% of cuts. But the trajectory, of course, is it going to be closer to 1 or closer to 2? It's going to depend on all the data prints that will come out in the future. But importantly for us, I think we look at the investors and where they stand. We think that it's still supportive of a soft landing as the Fed is able to do that. And as the 10-year yields in the US are getting above 4% now, we are telling investors it is a good time to average in, to lock in the yield for your investment portfolio.
Fook, hi, it's Amina joining in as well. We've talked about the Fed. Let's talk about what's happening in China. That's been the big talking point for the last 10, 12 days. October 12th is an expected meet in China. Expectations are there could be some fiscal stimulus coming. Up until then, metals may remain quiet. How do you play the China story? Are you long China and are you aggressively adding incremental flows to Chinese equity markets?
Yeah, no, thanks for that. Indeed, the press conference by the Ministry of Finance on Saturday is going to be a big one. We had an earlier conference by the NDRC earlier in the week, which disappointed the market with a lack of details on fiscal stimulus. So really, the market is going to be looking for what kind of fiscal stimulus may be announced on Saturday. Look, in the near term, I think we've seen a very strong rebound, recognizing that valuations are very low. Positioning was very low. And then we've seen all this coordinated effort from policymakers driving the market higher. It ran up a lot in the near term. So there's a lot of expectations now of what might be coming next. I mean, we've got a base scenario, if you like, for the Hang Seng to be around 20,000 to 22,500. It is a wide range, but we expect it to be within that range. And if we do get a fiscal stimulus that's much larger than expected, and by this I mean something more than 2 trillion yuan, if that comes true, we think that the Hang Seng could move higher beyond our base range, even up to 24,000, depending on the package that comes through. But at the same time, if there is disappointment coming down, again, the Hang Seng could weaken below 20,000. So there's a lot of expectations out here, and whether the Ministry of Finance will come up with that on Saturday remains to be seen. And we also have to see what is the shape of fiscal stimulus Is it going to be something spent over 6 months, or 1 year, or 3 years? Right? It's not just the number, but the manner of the spend really matters as well. So what we're telling clients over 6-12 months is that stay invested in China with a core allocation. We do have a view that China is a neutral relative to global equities. So we say stay invested with a core allocation. But in the short term, there's going to be a volatile, depending on what kind of news comes through and whether we get a big fiscal stimulus announced on Saturday or even later down the road.
Fook, while you're neutral China, what's the view on India? Is there any sort of biases here? Are you underweight, overweight? And if you have to turn overweight, what is it going to take?
We are overweight India. We didn't Asia Japan. We do like India. It's our favorite market at the moment. And look, I think the story that we've been seeing for the past years actually is in terms of the structural growth and how that's helping. And we think that continues. We do think growth will continue to drive the market higher in terms of earnings growth that we see. Valuation is always a concern. But in a world where interest rates are being cut, we're slightly less concerned about valuation because lower rates will be supportive of valuation. And we think that earnings is really what's going to be driving it. So India is one of the markets that we do like within Asia, Japan. We're overweight on India, and especially on the large cap stocks in India. We think that that's got a better buffer in terms of the security. And so we think that's going to be beneficial. So we do like India overweight. And then within that, especially we like the large caps in India.